Picture this, a consistent income stream every month like clockwork just by making one savvy investment decision. Sounds tempting, doesn't it? Welcome to the intriguing world of monthly dividend exchange-traded funds, or ETFs for short. These financial gems offer a steady income stream, and they're often overlooked in the hustle and bustle of the stock market. With a unique blend of stability and potential for growth, monthly dividend ETFs can be an excellent addition to any investment portfolio. Whether you're a seasoned investor or just starting your journey, these ETFs can provide a cushion of regular income, making your financial future a bit more predictable. So, ready to dive into the deep end of the investment pool today? We're diving deep into two of the best monthly dividend ETFs on the market, SPYI and QQQI. Stay tuned as we unravel the mysteries and reveal the potential of these financial powerhouses. Hello viewers, if you are enjoying this content, and you do not want to miss future videos filled with even more tips, tricks, and inspiration, hit that subscribe button now to stay tuned with us, and remember to comment and share. First up, we have SPYI, a gem that shines brightly in the ETF universe. Now let's delve into the world of SPYI, an exchange-traded fund that has captured the attention of savvy investors far and wide. This fund's investment strategy is as intriguing as it is effective. It aims to replicate as closely as possible, before fees and expenses, the price and yield performance of the S&P High Yield Dividend Aristocrats Index. Now, if that's a mouthful, don't worry, we'll break it down. In essence, this index is composed of dividend-paying securities of the S&P Composite 1500. The key criterion? These companies have consistently increased their dividends every year for at least 20 years. Now that's a track record that instills confidence. The types of companies that SPYI invests in are varied, covering a broad spectrum of sectors. This diversification reduces the risk associated with investing in a single sector. It's like a well-balanced diet for your investment portfolio, nourishing it with a mix of different types of companies, all with an impressive history of dividend growth. Now, let's talk numbers. The annual yield percentage of SPYI stands at an impressive 4.5%. Yes, you heard it right, 4.5%. This yield, a measure of the income an investment generates, is a testament to the fund's focus on high dividend yield securities. But it's not just the yield that's impressive, it's the consistency. Because SPYI invests in companies that are, let's call them dividend aristocrats, they have a history of not just paying dividends but increasing them year after year. This makes SPYI a compelling option for those looking for a reliable source of income. So, there you have it, SPYI in all its glory. A fund that marries the stability of established, dividend-paying companies with the potential for consistent income generation. An ETF that shines brightly in the universe of investment options. SPYI, with its focus on high dividend yield securities, is indeed a promising choice for those in pursuit of consistent monthly income. Next, we have QQQI, another star player in the monthly dividend ETF league. Let's delve into the specifics of QQQI. This is an exchange-traded fund that has been making waves due to its unique investment strategy. QQQI is not your typical ETF. It doesn't just buy and hold stocks, instead it uses a method known as indexing. This means it aims to track the performance of a specific market index, in this case, the NASDAQ 100 index. In essence, QQQI mimics the NASDAQ 100, which is an index that includes 100 of the largest domestic and international non-financial companies listed on the NASDAQ stock market. This means QQQI's portfolio is packed with some of the biggest and most influential names in today's tech-heavy world. Think Apple, Amazon, Google. These are companies that are reshaping our world and driving innovation in countless sectors. But QQQI doesn't just focus on technology. The sectors it targets are diverse, ranging from consumer services to healthcare and even industrials. This diversity adds a layer of security to the investment. Because it's not all in on one sector, the risk of a significant hit due to a downturn in a single industry is reduced. And now to the number that has everyone's attention, its annual yield percentage. QQQI boasts a solid 3.8%. This means that if you invest $1,000 in QQQI, you could expect to receive about $38 in dividends over the course of a year. That's a pretty attractive proposition, isn't it? But it's not just about the numbers. It's about the strategy, the diversity, the focus on sectors driving the future. It's about the potential for growth and the promise of steady, reliable dividends. QQQI's diverse portfolio and attractive yield make it an intriguing option for those seeking monthly dividends. So if you're looking for a way to generate some income while also investing in some of the most exciting companies of our time, QQQI could be just the ticket. Now that we've examined SPYI and QQQI individually, let's put them head to head. Let's start with the annual yield percentages. SPYI boasts an attractive yield of around 3.5%. This is quite impressive considering the market's volatility. On the other hand, QQQI has a lower annual yield, hovering around 2.5%, but don't be quick to dismiss it. Remember, lower yield does not necessarily mean lower total returns. Now let's talk about their investment strategies. SPYI follows a passive management strategy. It aims to track the performance of the S&P 500 High Dividend Index. This means it's heavily reliant on the performance of the broader market. QQQI, however, employs an active management approach. Its managers are constantly on the lookout for opportunities within the Nasdaq 100 index, providing a potential edge in performance. The sectors they invest in also reveal some interesting differences. SPYI's portfolio is well diversified across multiple sectors, with a significant emphasis on financials and healthcare. This strategy can provide a cushion in times of market turbulence. QQQI, on the other hand, leans heavily towards the tech sector. This could mean higher risk, but also higher potential returns. But let's not forget the similarities. Both ETFs offer monthly dividends, providing a regular income stream for investors, and both are backed by reputable firms with a history of solid performance. So which ETF is better? Well, it's not a simple answer. The best choice depends on your individual investment goals and risk tolerance. If you're looking for a more stable, income-focused investment, SPYI might be your pick. But if you're willing to take on a bit more risk for the chance of higher returns, QQQI could be just the ticket. Both SPYI and QQQI have their unique strengths, making them both worthy contenders for your consideration. So weigh your options carefully, and remember, investing is a marathon, not a sprint. It's all about making informed decisions that align with your long-term financial goals. So, which ETF should you choose for your portfolio, SPYI or QQQI? The answer, as always, depends on your individual investment goals. Let's delve into the ideal investor profile for each of these ETFs. If you're a cautious investor, one who values stability and a steady income stream, SPYI may be the better fit for you. With its focus on high-quality, dividend-paying international companies, SPYI offers a respectable annual yield, a testament to its commitment to delivering consistent returns. It's like the reliable workhorse steadily plowing through the fields of the investment landscape. On the other hand, if you're a growth-oriented investor, someone who is comfortable with higher risk for the potential of higher returns, QQQI could be your go-to. QQQI is designed to capture the performance of innovative companies on the Nasdaq, and while it may exhibit more volatility, it also has the potential for significant growth. Think of it as the spirited stallion galloping across the wide-open plains of the global markets. But let's not forget, both these ETFs have their own unique strengths. SPYI's focus on international dividend-paying companies offers a level of diversification that can help insulate your portfolio from region-specific downturns. Meanwhile, QQQI's emphasis on innovative companies gives it a dynamic edge, allowing your portfolio to benefit from the growth of the world's most forward-thinking businesses. It's like choosing between a steady marathon runner and a swift sprinter. Both can get you to the finish line, but the journey will be different. The marathon runner, like SPYI, promises a steady-paced journey. The sprinter, like QQQI, promises a potentially faster but also more unpredictable ride. So take a moment to reflect on your investment objectives and risk tolerance. Are you in for the steady jog or the thrilling sprint? That's a question only you can answer. Remember, the best investment is the one that aligns with your financial goals and risk appetite. Investing in monthly dividend ETFs like SPYI and QQQI can be a game changer for your financial future. We've dug deep into the benefits of these two powerful players in the investment arena. Remember, SPYI is a strong contender with its impressive annual yield percentage, and QQQI, on the other hand, is not to be underestimated with its own compelling yield. But it's essential to remember, investing is not a one-size-fits-all endeavor. What works for one might not work for another. It's all about your financial goals, risk tolerance, and investment horizon. So before you dive in, do your homework. research, compare, and analyze to make an informed decision that aligns with your financial objectives. And remember, the market is a dynamic entity, constantly evolving and changing. Staying informed and adaptable is key to successful investing. Thank you for joining us today. If you found this video helpful, don't forget to subscribe, like, and share. Until next time, here's to your financial success.